Well, the Eurozone crisis continues to hinder economic activity around the globe, and according to the Industrial Development Corporation, if the detrimental effect on trading patterns continue, South Africa would be one of the BRICS economies most affected. Joining us now for a look at this and more is Henk Potts. He's head of global research and investments at Barclays Wealth. Thanks so much, Henk, for joining us today. Well, as you sat down, I said apparently you're going to be speaking in South Africa about making sense of an uncertain world. I mean,
that's a pretty big task to do to start off with.
And what do you know that the rest of us don't?
Well, we know there's an awful lot of uncertainty out there, but it's trying to put it in some sort of context. I think you highlight clearly the biggest determining factor of financial market performance in the near term is going to be the ability of European officials to try and make progress on solving the sovereign debt crisis. Now, we've had 20 emergency summits in the past 23 months, so there's been plenty of opportunities for officials to come together and try to put some measures in place to deal with the crisis. The good news is, I suppose, that the pace of progress has been picking up. If you go back to the latest European Central Bank meeting, Super Mario stepping up to the plate, delivering that unlimited short-term bond buying program. So some good news in relation to that. And of course, the European Summit coming up with the ideas that bailout funds can be used to stabilise struggling bank balance sheets, can be used in terms of bond markets for peripheral bonds. So good news in terms of, at least in the short term, reducing the risk of default, allowing some of those peripheral countries to refinance themselves. But there are some much longer term concepts that the market needs to hear an awful lot more about. I think number one, the roadmap to fiscal, economic and political union. We don't really see a clear pathway in terms of how that's going to happen. Part of the solution also has to include, how do you stimulate growth? How do you generate those job opportunities within the Eurozone? And I still believe, number three, that you need some sort of fiscal burden sharing solution, some sort of Eurobond to transfer some of the problems that we've been seeing in peripheral Southern Europe to core Europe. So some really big challenges out there. The bad news is, of course, it can't happen overnight.
Yeah.
The bad news is, of course, that that fantasy that you just spoke about, Henk, good afternoon, by the way, of fiscal, economic and political union is indeed that. It's just a fantasy. I was watching last night a fantastic football match between Barcelona, the best team in the world, and Real Madrid, the pretenders for that title. And before the game, you should have heard the Catalans singing the Barcelona anthem. And one of the reasons that they were singing it so fervently was because they're coming up with an election quite soon to split themselves from Spain. So, I mean, it's just a matter of time, surely, between the whole of Europe unravels and we go back to cheap olive oil and cheap holidays in Greece, and Catalonia being a separate region from the whole of the mainland Spain.
Well, I was watching El Clasico myself yesterday, and it certainly was a stunning match, and a lot more enjoyment coming through from football than there has been from financial markets recently. You certainly highlight a couple of points there. Number one, of course, is that actually what makes good short-term political strategy doesn't often marry with long-term economic strategy. And that's something we've seen in Spain, but we've also seen Chancellor Merkel struggling with in Germany as well. The hope is that they can set aside some of those smaller national domestic debates and look to the long-term future of the Eurozone. Because it's worth remembering, of course, it's certainly not within anyone's benefit for the Eurozone to break apart. Even if you're talking about peripheral Eurozone countries, they clearly need to have the benefits of being part of the Eurozone. But even if you point to Germany, for example, you could argue, I suppose, that, listen, the Germans are fed up of writing these checks for the Eurozone. But if they were to leave the Eurozone, their currency would appreciate dramatically, maybe by around 40%. The borrowing costs of everyone else in Europe would go through the roof. The consumers would have a tough time. Their economies would be in recession. Who is going to be buying German products? So the good news is that the reality is that all of Europe needs to continue to try and make the European project work, probably with the exception of Greece. You can certainly argue with or without Greece, the debate has moved on, but Greece could leave the Eurozone and that wouldn't be the end of it. But to have the the major constituents within the Eurozone is obviously important. We still believe the Eurozone project will be around, but actually to get to that fantasy, to get to that Shangri-La that we were talking about, economic, political and fiscal union, unfortunately may take a decade.
Yeah, of course. I mean, you talk about these lofty goals, long-term horizon. I mean, where are convictions levels sitting right now? I mean, how are you rating that when you talk to investors out there? Where's sentiment sitting? Because like you say, 20 emergency summits later,
it's difficult. It's difficult. There's no doubt about that. And somewhat of a debate taking place about this idea that we've moved into a new normal world. And I suppose a new normal world from an economics perspective in its simplest form is the idea that the growth that we can expect from the developed world will be considerably less than we've seen by historic standards. The interest rates will be kept at very low levels for a prolonged period of time. That certainly feels like what we're seeing at the moment. And while returns from riskier assets, particularly the likes of equity markets, on average are positive, feel a little bit disappointing. And I suppose by those criteria, that's exactly what we've seen in terms of sentiment and market performance during the course of this year. Yes, growth has been difficult in the US, Europe, of course, struggling to grow at all. But worth remembering, of course, some of those riskier assets have performed incredibly well, particularly developed market equities in the US, but also in Europe as well.
Henk, I mean, just going back to the European story, again, I think it's a lovely, lovely idea, and I really wish it could work. I just think it's inappropriate.
Work with me on this one. I feel we're getting some speed behind us now.
And I think you know what I'm talking about. But let's get away from that. I just hope that Angela Merkel, when she arrives in Greece later on today, she doesn't get too hostile a reception. But
rather her than me, I would say.
A very nasty reception committee for her, because the Greek people do blame Germany in many ways for their current woes, despite the fact that they were the engineers of their own demise in the first place. One of the things, Alishia said that you're the person that can make sense of an uncertain world. Why is there such a dislocation between macroeconomics and markets? People keep saying, well, it's such an uncertain world at the moment. But since 2009, the markets have been on a roll. I don't see the uncertainty anywhere apart from the macro side.
Well, you're exactly right. And there's a contrasting picture that certainly emerges there. On one side, you've got these very dark headlines that you're seeing about the macro environment, the risks that we see in Europe, some suggesting the recovery that we've seen in the United States has been disappointing. The headlines out of China, the worst growth in 3 years. That's until you remember the fundamental number still looks actually quite good. But on the other side of that coin, what you've got is still an incredibly bright corporate picture. Companies are actually really in good shape at the moment. Now, if you go back to 2010, look at the global quoted corporate sector, you've seen profitability growth of around about 65%. It's been an incredible bounce back. Companies are much leaner and meaner than they were before. They're far more efficient. So even though we're in a period of rather anemic economic growth, it's very quickly filtering through to the bottom line. Balance sheets outside the financial sector, incredibly healthy. More cash on US corporate balance sheets today than has ever been the case in history. In some ways, that's a negative, of course, because they're not spending, they're not investing. Bad news for the economy, but actually a safety measure and insurance if you're an equity investor. And also, what are they doing with some of that money? They're returning it back to shareholders. Look at the big increases in dividends that have come through, the share buyback programs that are coming in. And remember, given that explosion that we're talking about in terms of profitability, the relative underperformance of equity markets over the course of the past few years actually would still tell you valuations look cheap. Still plenty of headroom for long-term equity investors, particularly in the United States, and some wonderful opportunities in the Eurozone.
Well, I've got to say to you, you know, we've got two very different views here, because Lindsay, you will come to know, is quite a bear. You sound very bullish, very optimistic.
I think you've got to be pragmatic about it. I think you highlighted really the point there. Difficult macro environment, but that isn't what drives share price. GDP does not drive share price. You know what drives share price? Earnings per share growth.
But then, Henk, we've got, after a sluggish second quarter, market expectations calling for a 3% year-on-year decline in US third quarter earnings, with potential upside surprises. Aggregate estimates for 2012 S&P 500 earnings are at $102.35, implying 5.2% year-on-year growth and some reacceleration only in the...
Not that bad. The year-on-year growth is not that bad. Listen, we've come from a very low base. It's admitted that. We've seen 12 quarters now of consensus beating results coming out of corporate the United States. So listen, the second quarter was disappointing. maybe saw growth of 0.6%, maybe up to 1%, but not a fantastic figure. The third quarter is going to show a little bit of some of the pessimism that's been coming through in terms of corporate America. There's no doubt about that. But in terms of the full year expectation, not that bad at all.
Expectations or relative, where that expectation bar has been set in the first place.
But I think even if you were to be pessimistic and take some of the most pessimistic views in terms of earnings growth over the course of the next couple of quarters, or even as you move into 2013, remember that's already been reflected in terms of the valuations. Look at the price that you're paying. So listen, there is going to be some disappointment. We've had some pre-warnings coming through from the US corporate earnings season, but the long-term corporate earnings picture in the United States and actually elsewhere in the developed world still looks pretty good.
Henk, the reason I'm bearish that Alishia told you my secret is because I'm too stupid to understand the relationship between GDP and the performance of companies and therefore the performance of the stock markets. But what I do understand is that you look at the American earnings season, which is coming up, and it's going to be the worst since 2009, but that's probably already factored into the market. As a long-term investor, I would look at companies in Europe now. For example, Coca-Cola bottlers in Greece, VW on a PE of 3.5. There's some incredible bargains from some incredibly good companies in a beaten up region of the world.
You won't find an argument from me in regards to that. Listen, we've been telling our clients for some time now, look for the opportunities out there. Remember, we're in the business of mispriced risk. I spend a lot of time with clients and I tell them, or I ask them, when do you buy into stock markets? And they all put up their hands and they tell me, Henk, I buy into stock markets when they're weak and cheap. But you know, the truth is that's not when they do it. Really, and clients make the mistake of buying into stock markets when they're strong and expensive, when the headlines are great and when their friends have been making money. But that's not the opportunity. As you pointed out, we're in the business of understanding mispriced risk, and that's exactly what you see in terms of the Eurozone. Some tremendous valuations, companies that have been beaten up. But remember, these aren't companies that are solely limited to their fortunes from what they see within the Eurozone. These are internationally diversified companies, and this is where some of the benefits are going to come from. You only have to look at the Xetra DAX in Germany to see the fact that some investors are starting to pick up on that idea.